Hey, what's up guys, it's Jonathan here, back with another public stock portfolio update. So as usual, we'll do a recap of some of the moves that we made in the portfolio this week. Then we'll do a recap of how the portfolio is doing overall. We'll talk about a couple things that happened in the market this past week that's important to keep an eye out for. So with all of that said, please hit the like button for YouTube algorithm. It greatly helps out the channel, help push this video out to as many people as possible. So let's get right into it. So as usual, we deposited the $10 into the public account. And as always, if you guys want to see the moves that I make in the public account, check out the link down below for public, where you can get a free stock worth up to $70 by using the link down below. So this week we made one buy order. So late on Friday, we bought $3 worth of Tesla at $865.39 a share. And late on Friday, the market fell pretty sharply when news came out that the US government recommended that any US citizens in Ukraine should evacuate as soon as possible, signaling the possibility of Russian military forces invading into Ukraine. This caused the entire market to fall into a close late on Friday, leading many investors to buy safety assets like gold and bonds, as we saw the price of those assets move up late in the trading day on Friday. So now let's go into the iPad and do a quick review of how the portfolio is doing. Currently, the portfolio sits at $182.36. And we're down almost 19% all time on the portfolio. And the first position we have in this portfolio is Tesla. Our Tesla position is currently down almost 2.5%. It makes up a little over 17.5% of the portfolio. Next position we have is Enphase. Our Enphase position is currently down 12%. We'll talk more about Enphase later, but Enphase had a really interesting week where it started off pretty strong and kind of fell apart during the last parts of the week. Currently, our position at Enphase makes up a little under 17.5% of the portfolio. The next position we have here is Robinhood. Our Robinhood position is currently down over 51%, makes up a little over 10.5% of the portfolio. Recently, we have started to see Robinhood kind of chill out in that $14 range there. It'll be interesting to see how it breaks from this flatness it's been seen over the past couple of trading days. The next position we have here is Google. Our Google position is down 6%. It makes up a little under 10% of the portfolio. Our next position here is Etsy. Our Etsy position is currently down 25% and makes up about 9.5% of the portfolio. Our next position here is Nvidia. Our Nvidia position is currently down almost 10% and makes up about 7% of the portfolio. I believe Nvidia is reporting earnings next week. I'm not 100% sure on that, but if they are, I'll most likely live stream it. So look out for that. Next position we have here is Amazon. Our Amazon position is currently down almost 11% and makes up about 3.5% of the portfolio. I think Amazon is still going to have quite a bit of pain until we start to see massive reductions in the cost of shipping. The next position we have here is Cloudflare. Our Cloudflare position is currently down 14.5%. It did run pretty well this week, especially off of its news of beating earnings that it reported, I believe, on Tuesday. And it currently makes up 3.2% of the portfolio. Next position we have here is Trade Desk. Our Trade Desk position is currently down almost 9%. It makes up 2.5% of the portfolio. In previous videos, I have stated that I don't think that advertising companies are going to do as well as I thought they were going to do at the beginning of the year, mostly because it seems like the supply chain issues continue to persist. So the next position we have here is Matterport. Our Matterport position is currently down 50%. And makes up a little under 2.5% of the portfolio. Matterport is one stock I'll say that has been beaten up pretty badly. So the next position we have here is SoFi. Our SoFi position is currently down almost 11% and makes up a little under 2% of the portfolio. So the next position we have here is Palantir, and our Palantir position is currently down almost 42%. Palantir has gotten hit pretty hard recently, so this isn't any surprise to me. And it currently makes up a little over 1.5% of the portfolio. Next position we have is Redfin. And our Redfin position is currently down almost 40%. I have started to see Redfin start to bounce a little bit this past week. So that's good news, but it's still down pretty significantly from where our cost basis is around $50 a share. And it currently makes up about 1.33% of the portfolio. So a recap of some of the things I'm looking at in the market this past week. I did read/listen to some earnings calls this week. If you're subscribed and you had a notification bell on, you have seen that I streamed not only the Enphase live stream, but also the Disney live stream as well. And the reason why I've been reading the transcripts from these earnings calls is because I'm looking for any evidence of possible persistent inflation continuing, or how these companies are being affected by inflation and what their plans are to combat inflation, especially if it does become not as transitory as what it was thought to. Enphase in their earnings call said that they will be raising prices in March of this year. And on the earnings call, the CEO stated that he doesn't believe the price increase will affect demand, given that demand for Enphase's products are inelastic. Also, given that there's a large backlog in fulfilling battery orders. The company also talked about how they're not trying to pass off all the increased costs onto their customers. As an investor into the company, it's a good sign that this company has pricing power. And because their product is so unique, they have the ability to raise prices if they need to in the future. And it's also a good sign because it shows that the company does have very good margins. When I look through Affirm's earnings call, they say that in their future guidance, they had baked in about 7 rate hikes for 2022. Last time I did a CPI update video in January, we were talking about a possibility of 3 rate hikes for an entire year. And now we're talking about 7 rate hikes. Many market participants like companies and investors have started to plan out for. But my big fear is that what happens if next month we now have 10 possible rate hikes, and then the month after that we have 15 possible rate hikes, mostly just because a lot of these inflationary forces seem to be ramping up more than they are cooling down. So that's something there to keep in mind. Also, Affirm talked about how their products will actually become more important in an inflationary environment. And that when prices of goods go up, it'll actually give the consumer more buying power even though inflation is moving to the upside. This is true, but you have to be careful with this line of thinking, because if we know that the Federal Reserve is looking at inflation and looking to combat inflation using their tool of monetary policy, we have to think about it that if a consumer stays strong and inflation continues to move upwards, that's only going to cause the Fed to become more and more aggressive on trying to put out the fire called inflation. And in that situation, the Federal Reserve could easily end up over tightening and actually cause contraction in the economy, leading to a recession. And in a recession, think about it like this. If you lose your job and you have to choose between your rent bill, your light bill, your water bill, or your heat bill, or your Affirm bill, guess which bill is going to get paid last? Probably going to be the Affirm bill. Let's be honest here. So that is a massive risk to Affirm, that if we do end up going into recession for whatever reason, this is a company you don't want to be anywhere near it. So if you're in it, awesome, just be careful about it. Then we also got earnings this week from Chipotle. And Chipotle talked about how their cost of beef, avocado, and shipping is already starting to erode at the price hikes they enacted. And the company talked about how it's expecting wage inflation to continue to keep growing. And they also talked about how they've been experiencing construction inflation as well, as they try to expand into new stores in their various markets. And Chipotle also stated that they do feel like they have the pricing power to be able to combat inflation. And they feel like they're providing enough value at that price point that they do have the ability to be able to raise prices more if need be. But at the same time, they also understand what their business model is, and they are being very sensitive to raising prices any more than they have to. So moving on to the CPI print that we got this month, the market was expecting a 7.3% move year over year, and we ended up getting a 7.5 year over year move. And because of this miss, we saw a substantial fall in the stock market during the pre-hour markets on Thursday. But the market did recover throughout the day. So some of the highlights from the CPI report: jewelry is up 9.3%. Butter is up 6.4% month over month. Even though electricity was up 4.5% this month, gas was actually flat, which was a good thing to see. When it comes to rental cars actually deflated 10% month over month for the month of January. And in my opinion, I think that was mostly due to Omicron. Then also on Thursday, the president of the St. Louis Federal Reserve stated that he would like to see a 100 basis point hike by July 1st. And by 100 basis points, it pretty much just means a 1% hike. With there being free FOMC meetings between now and July 1st, that would mean that we would probably need to have 2 quarter rate increases. That will most likely come in May and June. Then a half rate increase in March, which is a little bit more aggressive side of his expectations right now. And then he believes that the Fed should move off of the newer data that they get later on in the year and determine how they're going to adjust rates then. But one of the things that Fed Chair Bullard did say that did concern the market a little bit is that he also talked about the possibility of having emergency meetings in between the scheduled meetings that the FOMC has. And this level of aggression is not surprising given that Bullard is known to be on the more hawkish side of the spectrum. And the market did react and start to move downwards for the rest of the day on Thursday as soon as that move came out, after the market had recovered from the CPI print. For me, that kind of reiterates why I'm not really too excited to buy into this market. When I see someone from the Fed make a comment like that and the market just acts haywire like that. Because I have said that, hey, if inflation gets worse, the Fed is going to become tighter on their policy. And if the Fed becomes tighter on their policy, the market will react. This is a really good test to see that thesis is probably going to be pretty true for the near future. So when it comes to Russia, you've all probably heard about this, but on Friday, the U.S. government did recommend that any American citizens in Ukraine should evacuate as soon as possible, as the U.S. military will conduct no recon missions for U.S. citizens that are stuck in Ukraine, in the case Russia was to invade Ukraine. But even just that news caused the market to sell off late on Friday. So I think that if we were to have an event where Russia was to move in, we would probably see some really strong short-term pain in the markets. And if you are someone who is buying the dip during this Fed tightening cycle, I will say that this is probably a really good opportunity to buy the dip. One thing I will say is that if Russia does end up invading Ukraine, this could probably cause oil prices to jump pretty significantly. Mostly because 12% of the world's oil does come from Russia. And a lot of countries that import Russian oil have already talked about starting to cut those ties off in the case that Russia was to move into Ukraine. So we would probably see a pretty nice spike in oil prices. So on top of the 40% inflation we've already seen on gas prices, we'll probably have a little bit more left because of this conflict. That would cause even more disruptions in the supply chain. And honestly, in my opinion, if Russia was to invade Ukraine, you could almost guarantee pencil in a recession for some time at the end of the year this year. Just given the fact that the economy is already at a very fragile point, and if this situation blows up, it could just become a lot worse. So I would say, if you're a buy a dipper, make sure you have your cash ready and make sure you're ready to go and buy the dip if we do start to see some pain in the markets over this Russian news or over any of the other news that we have out in the market. So that's all I got for you guys this week. Thank you so much for watching. If you enjoyed this video, please hit the like button for YouTube algorithm. It greatly helps out the channel, helps push this video out to as many people as possible. If you enjoy my perspectives and the way I explain things, consider hitting the subscribe button and notification bell. If you made it this far to the video, you'll probably like my other videos, so why not hit that subscribe button and see what this channel is all about. Also, let me know what you guys think about the markets in the comment section down below. I'd love to hear from you guys. Check me out on all my social medias. I try to post there at least a couple times a week. So if you're interested, check me out there. And thank you guys so much for watching. I'll see you in the next video.